Welcome back to Boni's Life, the channel where we decode the markets so you do not have to lose sleep or your portfolio. I am Boni, and today we are diving deep into one of the most fascinating and frankly nerve-wracking moments in crypto history. Whether you are a short-term scalper, a mid-term swing trader, or a long-term holder who checks their portfolio once a month and pretends everything is fine, this episode is built specifically for you. We are going to break down exactly what is happening in the crypto market right now, where it might go next, and most importantly, how you can position yourself to come out ahead. So grab your coffee, your notebook, and whatever calms your nerves, because the data we are about to unpack is both alarming and full of opportunity. Let us start with the big picture. As of March 7th, 2026, Bitcoin is trading at approximately $67,943 according to CoinGecko, sitting about 46% below its all-time high of $126,080 that was set back in October 2025. The total cryptocurrency market capitalization stands at $2.4 trillion, with a 24-hour trading volume of $68.45 billion across all exchanges. Bitcoin dominance is at 56.6% on CoinGecko and 58.47% on CoinGlass, which tells us something very important. Money is flowing into Bitcoin and away from altcoins. Ethereum, the second largest cryptocurrency, is trading at $1,985 with a market cap of $239.5 billion, down roughly 60% from its all-time high of $4,946 set in August 2025. The ETH to BTC ratio has fallen to 0.02922, which is a level we have not seen in years, and it signals that Ethereum is significantly underperforming Bitcoin in this cycle. Now here is where things get really interesting, and I would argue really important. The Fear and Greed Index, as reported by CoinGlass and Alternative.me, has plummeted to 13, which places us firmly in the extreme fear zone. To put that in perspective, a reading of 13 is lower than what we saw during the FTX collapse in November 2022. Historically, when the Fear and Greed Index drops below 15, it has marked some of the best long-term buying opportunities in Bitcoin's history. But, and this is a big but, it has also preceded further short-term pain. So the question is not whether this is a good level to buy. The question is what your time horizon is. And that is exactly what we are going to address today. Let us talk about the derivatives market, because this is where the real story unfolds. According to CoinGlass, total open interest across all crypto futures stands at $96.45 billion, down 1.34% in the last 24 hours. Bitcoin-specific open interest is $44.36 billion, while Ethereum open interest sits at $25.64 billion. Now, the 24-hour liquidation figure is $135.37 million, which is actually down 61% from the previous day. That tells us the market has already flushed out a significant amount of leverage positions. Earlier this week, we saw over $500 million in short liquidations in a single cascade event when Bitcoin surged from its lows near $64,855 back up to $73,669. The current long-to-short ratio across major exchanges shows 48.9% longs versus 51.1% shorts, meaning the market is slightly tilted bearish. However, and this is crucial, top traders on Binance are actually positioned long with a ratio of 2.04 on accounts, and OKX shows a long-short ratio of 1.94. So the smart money is leaning bullish while the broader market is fearful. That divergence is one of the most powerful signals in trading. The funding rates across major exchanges are slightly negative, with Bitcoin at negative 0.0005% on Binance and negative 0.0012% for Ethereum. Negative funding rates mean that short sellers are paying long holders, which typically indicates bearish sentiment, but also creates conditions for a short squeeze. When you combine negative funding with extreme fear and declining open interest, you get a market that is coiled like a spring. It can snap in either direction, but historically the snap tends to favor the upside when fear is this extreme. Now let us zoom out and look at the volume picture. The 24-hour futures trading volume is $114.5 billion, which is down 40.81% from the previous session. Bitcoin alone accounted for $43.18 billion of that volume. This decline in volume is significant because it tells us that traders are stepping to the sidelines waiting for clarity. And what are they waiting for? They are waiting for the same things we are about to discuss: the geopolitical situation and the macroeconomic data. Let me walk you through the global events that are shaping this market right now, because if you are trading crypto without understanding the macro environment, you are essentially driving blindfolded. The single biggest factor weighing on markets is the ongoing US-Israeli military conflict with Iran, which is now entering its second week. This conflict triggered a massive sell-off across all risk assets, with Bitcoin dropping from around $73,000 to $64,855 in a matter of days. Oil prices have surged to approximately $80.88 per barrel for Brent crude. The VIX volatility index is elevated at 24.94, and gold futures have rocketed to $5,171 per ounce, up 1.85%. The US dollar index has actually weakened to $98.85, down 0.47%, which is interesting because in a traditional risk-off environment, the dollar usually strengthens. This weakness suggests that markets are pricing in potential Federal Reserve rate cuts, which brings us to our next major catalyst. The Federal Reserve is currently holding rates at 3.50 to 3.75%, and the CME FedWatch tool shows a 98% probability of no change at the March 18th to 19th FOMC meeting. However, and this is where it gets fascinating, the February non-farm payrolls report that was just released showed a significant slowdown in job creation, with consensus at 60,000 jobs versus 130,000 in January. Forbes just published an article titled, "The Fed's Bitcoin Price Nightmare is Suddenly Coming True," arguing that an AI-driven jobs disaster is pushing the Federal Reserve toward rate cuts, which historically sends Bitcoin sharply higher. If the Fed does pivot toward cutting rates in the second quarter of 2026, that would inject massive liquidity into the system and could be the catalyst that sends Bitcoin back toward its all-time high. There is another massive story that most people are not paying enough attention to, and that is the US Strategic Bitcoin Reserve. President Trump signed an executive order to establish a strategic Bitcoin reserve with plans to acquire up to 1 million Bitcoin. However, as CoinDesk reported just hours ago, the executive order has been languishing, awaiting congressional action. Cathie Wood of ARK Invest has called this the missing X factor for Bitcoin, arguing that if the US Treasury begins aggressive buying, it would create unprecedented demand pressure. Meanwhile, the Clarity Act, which would establish comprehensive crypto market structure legislation, has stalled in Congress, with Trump publicly blaming banks for the delay. These regulatory developments create both uncertainty and enormous upside potential. On the institutional front, spot Bitcoin ETFs now collectively hold approximately $88 billion in Bitcoin, representing about 6% of the total supply. Ethereum ETFs hold $13 billion in assets under management. The ETF flow data from CoinGlass shows a mixed picture this week. We saw net outflows of 4,920 BTC on March 6th and 3,140 BTC on March 5th. But that followed strong inflows of 6,760 BTC on March 4th and 6,970 BTC on March 2nd. The cumulative total since inception stands at an impressive 700,830 Bitcoin. What this tells us is that institutional investors are not abandoning Bitcoin. They are tactically adjusting positions around geopolitical events. Now, let us get into the technical analysis, and I'm going to break this down by trader type because a 4-hour chart setup is completely irrelevant to someone with a 12-month time horizon, and vice versa. Starting with the short-term traders, those of you operating on the 15-minute to 4-hour time frames. Bitcoin is currently trading in a descending channel between $67,495 and $68,988 on the daily range. The average RSI across the market is 42.74, which CoinGlass classifies as neutral. For short-term traders, The key levels to watch are $67,000 as immediate support and $70,000 as the first resistance. A break below $67,000 could trigger a move toward $64,855, which was the recent swing low. On the upside, a decisive break above $70,000 with volume would target $73,669, which was the weekly high. The golden cross signal that analysts noted today, where the 50-day moving average crosses above the 200-day, is a bullish technical signal, but it needs confirmation with volume. For midterm swing traders operating on the daily to weekly time frames, the picture is more nuanced. Bitcoin has been consolidating in a range between $64,000 and $74,000 for the past 2 weeks. The 30-day price change shows a decline of 2.4%, but the 7-day change is positive at 5.4%, suggesting a potential trend reversal. The key technical setup here is a potential inverse head and shoulders pattern, forming on the daily chart, with the left shoulder at $65,000, the head at $64,855, and a potential right shoulder forming around current levels. If this pattern completes and Bitcoin breaks above the neckline at $74,000, the measured move target would be approximately $83,000. For Ethereum, the critical level is $2,000, which has been acting as both support and resistance. A weekly close above $2,200 would confirm a bullish reversal for ETH. For long-term investors and holders looking at the weekly and monthly timeframes, the current setup is arguably the most compelling it has been in over a year. Bitcoin is 46% below its all-time high with the Fear and Greed Index at 13, exchange reserves declining by 4,320 BTC to just 2.44 million, and the remaining supply to be mined now below 1 million BTC. The supply dynamics are extraordinarily bullish. Bitcoin's circulating supply is 19,999,115 out of a maximum 21 million, meaning we are approaching absolute scarcity. Historically, buying Bitcoin when the Fear and Greed Index is below 15 and holding for 12 months has produced positive returns 94% of the time. The altcoin season index at 45 on CoinGlass, classified as neutral, combined with 38% of altcoins trading at all-time lows, suggests that when the rotation eventually comes, the upside for quality altcoins could be explosive. Let me give you specific trade setups and triggers. For short-term traders, here is what I am watching. Long trigger. Bitcoin reclaims $70,000 with a 4-hour close above that level and increasing volume. Target 1 is $73,669. Target 2 is $75,000. Stop loss at $67,000. Short trigger. Bitcoin loses $67,000 on a 4-hour close with expanding volume. Target 1 is $64,855. Target 2 is $62,000. Stop loss at $69,000. Risk to reward on both setups is approximately 2-to-1, which is the minimum you should accept. For Ethereum short term, long above $2,000 targeting $2,179, short below $1,957 targeting $1,888. For midterm swing traders, the setup is clearer. Accumulate Bitcoin between $64,000 and $68,000 in tranches, not all at once. Set your first profit target at $80,000 and your second target at $90,000. Use a weekly close below $60,000 as your invalidation level. For Ethereum, accumulate between $1,800 and $2,000 with targets at $2,500 and $3,000. For Solana, which is trading at $83.98, the support zone between $80 and $85 offers an attractive entry with targets at $100 and $120. For long-term investors, the strategy is straightforward but requires discipline. Dollar cost average into Bitcoin and Ethereum at these levels. The extreme fear reading of 13 is historically a generational buying zone. Allocate 60% to Bitcoin, 25% to Ethereum, and 15% to a basket of quality altcoins including Solana, XRP, and Chainlink. Do not use leverage for long-term positions. Set a 12 to 18-month time horizon and ignore the daily noise. Now, let me outline the strategies that will help each type of trader navigate this market successfully. For short-term traders, risk management is everything. Never risk more than 1 to 2% of your portfolio on a single trade. Use the negative funding rates to your advantage. When funding is negative and fear is extreme, the probability of a short squeeze increases significantly. Watch the liquidation heat map on CoinGlass, because the dense liquidation clusters between $71,000 and $72,000 act as magnets for price. Trade the range until it breaks, and when it does break, trade the breakout with conviction. For mid-term traders, the strategy is about patience and position sizing. The FOMC meeting on March 18th to 19th is your next major catalyst. If the Fed signals any dovish shift, that is your green light to add to positions. The Bitcoin ETF flow data is your institutional sentiment indicator. Consecutive days of inflows signal accumulation, while outflows during geopolitical stress are temporary. Use the options market as your guide, because the 150% surge in options open interest to $44.85 billion tells us that institutional traders are positioning for a significant move. The question is direction, and the put-call ratio will give you that answer. For long-term investors, the strategy is the simplest but emotionally the hardest. Buy when others are fearful. The Fear and Greed Index at 13 is screaming fear. The declining Bitcoin exchange reserves, now at 2.44 million Bitcoin with 4,320 Bitcoin leaving exchanges just today, tell us that holders are moving coins to cold storage, not selling. The potential US strategic Bitcoin reserve, if activated, would create a supply shock unlike anything we have seen. And the approaching Bitcoin supply cap, with less than 1 million BTC left to mine, creates a mathematical certainty of increasing scarcity. Before I wrap up, let me address the elephant in the room. The US-Iran conflict is a genuine risk that could escalate further. If it does, expect another leg down in all risk assets, potentially taking Bitcoin to the $58,000 to $62,000 range. Arthur Hayes, the co-founder of BitMEX, stated in a recent interview that markets are not pricing in a longer Iran war. And if the conflict extends beyond what is currently expected, the volatility could be severe. However, Hayes also noted that historically, geopolitical conflicts create the best buying opportunities for assets like Bitcoin, because the monetary response, meaning more money printing and lower rates, always follows the crisis. So here is the bottom line. The crypto market is at an inflection point. We have extreme fear, declining leverage, negative funding rates, institutional accumulation through ETFs, a potential US government buying program, approaching supply scarcity, and a Federal Reserve that may be forced to cut rates. Against that, we have an active military conflict, elevated oil prices, and regulatory uncertainty. The data tells us that the risk-reward for patient, disciplined traders is heavily skewed to the upside over the medium and long term, while the short term remains volatile and dangerous for the undisciplined. Thank you for watching Boni's Life. If this analysis helped you see the market more clearly, hit that subscribe button, drop a comment with your trading plan, and share this with someone who needs to hear it. Remember, in markets like these, the informed survive and the disciplined thrive. I will see you in the next episode. Stay sharp, stay disciplined, and as always, never invest more than you can afford to lose. This is Boni, signing off.